What's up, world? What's up, world? What's up, world? It's Monday. In fact, it is Mortgage Minded Mondays. It's a big difference from it just being Monday, right? It's also Labor Day, but we are here. I'm Tavares Jones, licensed stockbroker, licensed life insurance and annuity broker as well. And I have.
That's I don't even call that a drum roll. Maybe next week we just nix the drum roll because thank you for the drum roll. That's what I meant to say. Thank you. Thank you so much for the drum roll. I appreciate you giving me a drum roll to introduce myself. I am Hyacinth Henderson. That is Hyacinth like the flower. We representing the Henderson Financial Group. That's the name of the company, our firm. And I am a licensed stockbroker, licensed investment advisor representative, licensed annuity and insurance broker, and a mortgage loan originator. And yeah, we do Mortgage Minded Mondays. I know y'all can hear it. I'm nasally
Yeah,
or congested or whatever the case may be.
yeah.
So there's been a lot going on. And neglecting the self is one of the things that has been going on, but we're going to get that back together. Just know that whatever I got, Tavares got. So if you're gonna stay away from me, you're gonna stay away from him too. Same for Antonio too. My dad has been out of town, so he hasn't gotten close. But anyway, thank you so much for joining us. If you are new to this channel, we represent the Henderson Financial Group. We are a full service financial planning and investment advisory firm. We are based in sunny South Florida, Miami, Florida. However, we have clients all over the world thanks to the internet and its capabilities. On Mondays, we talk about mortgages. Give you helpful hints and tips and things like that. We just talk about
Sure.
everything that deals with real estate and sometimes a little bit of stuff that doesn't deal with real estate.
Yeah.
So today, we titled today's show Helpful Hints because there are so many different things that we wanted to talk about
Yeah.
and we're going to talk about. And all of them are of importance. All of them are topics that we know you will find beneficial and helpful on your journey. So it's titled Helpful Hints. We do hope that you find value in it. We know that you're going to find value. And let's get into it. Happy Monday, Mrs. Redhead. Happy Monday. Happy Monday. Happy Monday. I see your comment here, so I wanted to acknowledge you.
Yeah. So, so many. It's like a compilation of topics that we want to speak about. Um, you think it's good to start off with the Lisa since that deals with credit, and then
Yeah. Since we talked about credit,
credit last
right?
week. Yeah.
Yeah. And if they didn't catch last week's episode, go ahead and watch that. We talked a lot about credit. We talked about credit. We know some of y'all may be out there barbecuing and sleeping in. I'm in a group chat in for the PTA, and one of the ladies they wanted to do a call today, and the lady said it was like 4 o'clock. She said by 4 o'clock, I don't plan to be talking. She plans to be just fully having a good time.
Yeah.
So we know that although we are in the office, some of you all are enjoying the
life.
holiday,
Yeah.
right? Enjoying life, which is okay. Just make sure you run the tape back on this episode and also of last week's episode. We talked about credit.
Yeah.
Yeah.
Yeah. So as Heisey just mentioned, last week's show was about credit, right? And we gave you guys endless information on in how to increase your credit score, right? How to improve and increase your credit score. So rolling on from that conversation, actually just this past weekend, we had a family situation where we gathered, right? We had a family gathering and the topic of reverse mortgage came up. And one of my family members said, well, since we're not required to make any loan repayments or any payments towards that loan, why do we have to have good credit with the reverse mortgage? And I was like, man, that's a great question. And it'll make a great topic to speak about on the show. So, good credit is required with the reverse mortgages because you will have to pay your property taxes and your homeowner's insurance to avoid foreclosure. Though there's no monthly payment required to the lender or to the bank, you have to still pay property taxes and homeowners insurance. If you don't, you can't go into foreclosures. So what your credit score is, as we spoke about on the show last week, your credit score is basically like your report card as an adult. It shows how responsible you are when it comes to paying your bills. And the higher your score, the more of your passing level. Lower your score, the opposite. So when you have that low score, it tells the lender of the reverse mortgage company that you're not so responsible, right? Financially, right? You're not so responsible, and they want to help you avoid foreclosure. So what they'll say is, yes, you have a reverse mortgage and you are entitled to a line of credit. For some of you guys may be able to convert your equity into a line of credit that will grow at a tax-free 7% or 8% on an annual basis, which is beautiful. And you always have access to that money, tax free, and it's going to grow with compound interest. We love that. However, if you have a low credit score, the lender is going to take some of that money and sit it to the side. That's exactly what LESA stands for. LESA, life expectancy set aside. So they're going to set some of that money to the side, and they'll sit that in reserve so the lender can pay your property taxes and your homeowner's insurance from that portion of funds. So you'll still have access to some of the equity or some of the line of credit, but a portion of that will be subtracted. Sometimes all of that is subtracted. So your homeowner's insurance and property taxes can be fulfilled without you going into foreclosure. It's kind of like having training wheels on a bicycle. So some of us are able to ride big wheel bicycles like mountain bikes and stuff like that with no training wheels, but some people need that little assistance to make sure that they don't tip over and hurt themselves. So the LESA is just like having a bicycle with training wheels. You still have a bike and you're still able to pedal and you're still able to, get from one place to the other, but you still you got some braces on there.
You're so sweet. You said that so sweet. You said that so sweetly. The whole time, the savage inside of me said, the lender said, we're going to save you from yourself.
Yeah, that's what it is.
We're going to save you from yourself. Since your credit score and credit history has shown that there have been hiccups. And remind you, you have to be over 62 to obtain a reverse mortgage.
Yes.
So at 62 or higher, your credit report card, because we talked about what a credit score is and really what it's about on last week. So at 62 or higher, they're saying, child, we looked it up and we reviewed it and we want to help you, but we want to help you help yourself.
That's correct.
We want you to help us help you. We want to save you from yourself because we know that you won't have to pay a mortgage. And we know that you're over 62 years old. But your credit history is a little shaky. So what we're going to do, we're going to set some of this aside. We're not going to spend it. We're not going to take your money like you like to go out there and tell people, the lender took my money and they got all this money. They won't let me get this because they saw that when somebody else gave you all the money, you weren't very financially responsible with it. And they really don't want to foreclose on your house. I tell people all the time, the reverse mortgage people are in the lending business. They are not in the real estate business. That's very important because people say to me, well, when mama died, when I die, they're going to take my house. They don't want your house. Let's start there. They don't want your house. They want the interest. They want the money. That's how they continue to make money so they can go out and continue to give loans. It's one fantastic business model from their perspective. So what they're saying is, because here you are, you meet the qualifications, 62 or higher, you have equity in your home. Yes, we want to give you a reverse mortgage. And, credit, you don't need credit to qualify in a way that you would for a traditional mortgage, but your credit tells a story.
Yes.
It paints a picture, and the picture it has painted for us is that you've had some hiccups. We know it wasn't your fault, whatever the case may be. So we're going to set some money aside because since we don't want your house when the taxes are due and when the insurance is due, if you don't pay it, we don't want somebody to go down to the tax collector's office and then buy the tax deed. We don't want that to happen. We know that something may happen because something has happened before. And we want to be able to say, don't worry about it. We got something set aside for you. We didn't give it all to you at one time. So that's what that account is for. And when you start looking at it in that way, then you can kind of get out of your feelings a little bit. I was thinking about something the other day. Today's Monday. So maybe it was Saturday and I was driving and I said, how do you grow past something, or how do you get over something? How do you move from one space to the next? And the download that I got was with understanding. It is only when you come to the place of understanding, then you can be able to say, oh, okay, because if not, you're just waiting to get over it. You're just waiting to end the grieving process. You're just waiting to end the breakup process. You're just waiting to end whatever you're in. And, you may put some sugar on top of and it still be stinking. And you're like, I'm sprinkling sugar on it. Let me break it down. The sprinkling of sugar is I may be smoking it away. I may be drinking it away. But when I get sober, the pain is still there. Yes. I may be working it away. But when I'm not working, the pain is still there. I may be doing all of these things to move forward, but the pain is still there. And it's been days, weeks, months. Why is that? Because you have not gained understanding. You didn't seek understanding. So that applies to everything in life. And it also applies to the LESA. That's the acronym. Yes. The LESA. It also applies to the LESA. Once you understand what the LESA is for, then you can stop putting up a fight and saying, oh, well, they just want to take my money or they didn't give me no money. Once you get understanding, you're like, you know what, that makes sense.
Yeah.
Because the last thing that I want to do is to lose my house to somebody who's went down there and purchased my tax deeds because I couldn't pay the taxes and nobody could help me.
Yeah. And it's just a way to help you out,
Yeah.
right? So it's not, like Heisey just said, understanding, right? So once you understand why that parameter is in place, then you are able to easily digest it and move on and begin to enjoy having a life with no payments, right? Because that's really what it's about. And then you can capitalize on it from there. It's actually a beautiful thing, but it's even better if you have good credit, right? Because everybody wants access to cash. So last week's call, it'll be good. Not call. Last week's show will be good for people that are of all age. If you're looking to buy your first home, all the way up, if you reverse mortgage age, you're 61, 62 years old, and you're preparing for that next phase of life. Having your credit strong, having a strong credit score would be beneficial for people, even if you're not even purchasing a home right now. If you're trying to rent an apartment, they run your credit for that as well. If you need a new job, they run the credit for that as well. But right now we're focusing on mortgages. You
know why? As you were talking, it reminded me because people want to see.
Yeah.
And it goes back to what most of us know as humans. I'm sure you live by this, T, because I know you don't play that. Is don't believe what somebody tells you, believe what they do. Right? Sure. So your credit score allows whoever wants to extend credit to you to see what you have done. When they pull that credit report, they're going to see what you have done. They don't care about what you say and you make this amount of money and you can pay them back. And I promise I'm going to pay the property taxes and insurance. And I promise. If we move to the space in everything that we do of understanding, here's that word again, that you don't believe people's words. You just let them talk. You're just like, okay, the secret sauce is in what someone does.
Yeah, that's correct.
And your credit report is a history of what you have been doing. Yes. Isn't that beautiful?
Yes.
Such a beautiful, beautiful thing. So when you start to look at it in that way, not only as it relates to your credit, but as it relates to everything in life, just think about it. Somebody said one thing and did another. Well, you know exactly how they feel based on what they've done. You know that completely. They can say what they're going to do, but until they actually do it, their actions, what you say your granddaddy used to say, you make sure the
tongue in your mouth and the tongue in your shoe are in the same direction.
They got to be on the same page. Yeah. Love that. Your tongue in your mouth and your tongue in the shoe, meaning your action has to be on the same page.
Yeah. Yep. And not only is it showing you your action, what you do, but it's also telling somebody else how to treat you. Should we treat this person like a baby or can we treat them like an adult? Right? Are we going to overcharge them on interest, meaning these high interest rates? Or are we going to give them a LISA, meaning, extract a portion of their line of credit and sit that to the side so we can pay their bills for them? Or we're going to give them full access to it and just let them have at it and do their thing because they showed us that they're responsible. So your credit score, right? Nobody wants to be handled, right? When you walk into the bank and they telling you, when they run your credit, right? Now their persona changes about you, right? The way they talk to you, the way they treat you, it always changes. And nobody want to be handled that way. So you always want to have some money about yourself, and you definitely want to have a strong credit score.
Yeah, it's true. And what else? If you think about it, how else can people form an intelligent decision? Or I don't want to say an opinion or judge you, but how else can people form an opinion on what they should do in this moment just by listening to what you say? Well, the politicians teach us we can't listen to what they say, right? Yeah. All right, so let's talk about, you want to move on?
Yeah, for sure.
All right, let's move on. Let's talk about income. Income is a topic that we need to talk about, right? So last week we talked about credit and all these other different things, and we encouraged you, we motivated you, we inspired you, we reminded you that now is the time to buy the house. We reminded you not to be discouraged because of housing prices of what they are now, because we know without a shadow of a doubt, when you look in the next 10 years, prices are going to be higher in 10 years than they are today. So we encourage you to keep the faith and keep pressing and build a strategy. That was our word of the show last week, strategy. Build a strategy so that you can buy a house. So we talked a lot about credit. And so as I was thinking today, I said, you know what? Credit and income go together, because people might be like, all right, I'm getting my credits together. I'm suited and booted. I'm not going to let them put me on the sidelines and, steal my dream of owning a primary residence or an investment property or a second home. I'm not going to do that. But I need some money.
Yes, most definitely. Most definitely. And I'm glad that you came up with this portion, because sometimes we think that we're limited when it comes to income, right? And I know, Heisey, one of your favorite words is abundance, right? And actually, that word abundance is in a good book. I think it's in a good book. I need
Oh
to
yeah. Oh
touch
yeah.
up on my reading in there. But yeah, so your creator or our creator wants us to live an abundant life. So we don't have to be limited just to 9 to 5, right? So if you have a job where you starting at 9 and you get off at 5, you might take your little nap, right? But at the same time, if you know you have the goal to purchase a home, do a little digging, and use that time from 5 to 9, right? J. Cole had a line that said he was trying to holler at a girl, and he was like, I know you got a 9 to 5, but can I be your 5 to 9, right? Um 9 to 5, can I be your 5 to 9? So you can have a job in your 5 to 9, a second job in your 5 to 9 space, or a second hustle in your 5 to 9 space. A lot of people have access to overtime, right? I don't want to roll too fast into it.
No, you're good.
But extra income is always good when it comes to purchasing a home. Now, when it comes to income, you want to make sure that you're documenting that income. You're able to document it, because remember, your file is going to go into underwriting. And let's say if you got a small juice bar at a farmer's market and you're making cash, right? You're depositing this cash in. Remember, the underwriter is going to ask for where this cash is coming from. That may create a rabbit hole or a paper trail of where these funds are coming, or are these funds being are you paying taxes on these funds on an annual basis and things of that nature. So you want to be careful with that, but don't be scared to go out there and get it. Don't be scared to go out there and get it.
Yeah, very important. I love that you talked about this because, sometimes people can get stuck in a rut of thinking that, I'm stuck in this job, I'm limited to these hours. And you brought up a great point when you talked about overtime or a second job. I also love to remind people, especially if you have a skill set, if you have a professional license, or you are a professional if you are a subject matter expertise in whatever area it is, you can stay in that same field and add more pots of income on the stove for yourself. So this is what I'm seeing. I don't know why I just saw an auto body shop. So let's say someone who owns an auto body shop, and I don't know anything about cars except for when the lights come on, I need to wait a few weeks to a few months and then finally take it in. That's all I know about cars, right? But let's say you're offering, let me do something that's real time that I know. I don't know why auto shop came to me, but someone with an auto shop, that be a note to yourself that there's another line of income, line of work that you can add to your business, because it's just right here, and I just don't know about it enough to talk about it. But let me take you to something that's very real. So I needed to, I took my son yesterday to get some clothes. My grandmother's memorial service is coming up this Saturday. And so he needed the, pants and stuff like that. So they need to get altered. So, back in the days, we used to go to the flea market in Miami. They done shut down all the flea markets. So I'm like, I have my girl. Anyway, I was looking for alteration. I started finding cleaners that had tailors inside of the cleaners. And I said, this is so smart. Because when people come to bring their clothes to get dry clean, they may have some items that, I need this tightened up. I need this hemmed. I need this button put right there inside the cleaners. That's what we mean when we say find a way with what you're already doing in your already field to expand and increase your income. It's a beautiful way of, instead of saying we don't do that, find something that is a complementary service to whatever your subject matter expertise is. A lot of times I'll see nurses who start doing these, they're a registered nurse during the day, and then they start doing these IV services. And they'll come to you and they'll do IVs to give you B12 and all these different things and stuff like that. You'll see nurses doing traveling gigs. You'll see realtors who, start niching down, and then also they may say, I'm a realtor, but I also may do BPOs, broker price opinions. We saw a lot of realtors shift into that when the market shifted. So what I'm saying to you is, think about what you currently do and what service is complementary, and how can you add that to your tool belt. A perfect example is me in August, a month ago, going to obtain my mortgage loan originator's license. Perfect example. It all fits within. So when people ask like, I'm like, first of all, I own a business, so I need to have some type of knowledge on today's laws about the business. Because if not, like I explained last, I think on the show with my dad on Wednesday, if someone calls in, I can't give you bad information. I need to be licensed and understand so that your question, even if I am not the loan officer, even if Tavares is the loan officer, I need to be able to intelligently speak on it. So I knew that I needed to get another mortgage. I need to get the license. And so now I'm at the point, well, do I want to, how many mortgages a month do I want to do? Do I want to put up with it? Because like I said, doing mortgages, when you're talking about mortgages, and we talked about this on the show I did with my dad on Wednesday, when you do mortgages, you are a part of a significant life experience of someone.
That's true.
It is a huge experience. So this means, in a way, this is the way I see it. When I'm doing your mortgage, your goal comes to the top of my list. You want to buy this house? You under contract? I need to make sure I have all the ducks in the row. So now some of the stuff that I wanted to do, y'all know I love a good spa, a good massage, the beach. Now I can't go do those things because I have your closing date, that I need to make sure that all your ducks in a row, and I've given you a mortgage that is better than what you expected. So when you think about that, you're like, oh, okay, that requires a lot of work, right? So as I started thinking, I'm like, do I want to do mortgages for everybody? Do I want to, whatever the case may be? But the point is, it was a complimentary license that I went to get, so that if I want to do a mortgage a month, 2 mortgages a month, whatever the case may be, however it may look, depending on what's on my plate, I can increase my income. But increasing the income wasn't the goal. Now, I'm sharing that with y'all because there are some of you who are out there listening, and you do one thing and you go home. You do one thing and you go home, you have one license and that's it. And you think that you're doing the best that you can. And you're not. One of my favorite books is All You Can Do Is All You Can Do, but All You Can Do Is Enough. And I actually made that my email signature. In a couple of my emails, I got like 10 email accounts. But in a few of my email accounts, I made that my email signature recently as a reminder that I only want you to do all that you can do. But all that you can do
is all you can do.
Is all you can do.
Yeah.
And all you can do is enough. So now that begs the question, are you doing all you can do?
Yeah. That's a solid question, because most of us aren't, to be honest with you. Most of us aren't. And sometimes we just need a little push, right? Sometimes we need a little reminder that we can be doing more. And sometimes we don't know what we should be doing, right? And then Heisey just gave you a perfect example of how to look deeper within yourself to find that second part of what you can be doing, right? And it's just something I know. This is an area that I actually have to work on. So I'm not speaking from this area as an expert, but I heard someone say on YouTube the other day, whatever you do it in front of a camera, right? Whatever you do it in front of a camera. I'm not a camera type of person, but I'm growing into that, right? And I took that advice. That's something that has been following me and hunting me every day. Every time I wake up, every time I go to sleep, every time I get some free time, whatever you do, just do it in front of a camera. So if you cut hair, if you do flooring, right? If you do financial services, do it in front of a camera, and you can get that word out to the world. Get that message out to the world, and you can teach people. They got websites like Skillshare, websites like YouTube, of course. You got TikToks and things of that nature. And nowadays, a lot of people don't want to work, but everybody want to sit home and intake content. So you can just feed those people. And like I said, I'll be the first to admit I'm the first person to say that's something that I have to get out of my head with, right? So I know it's a push, and it takes a step. It takes some mental clarity. It takes some bravery. It takes some confidence and things of that nature for you to get in front of a camera and then to just speak. And you may have been doing this particular skill for 10, 15, 20 years, but when the camera comes on, you just might, you might get nervous, or your palms might start sweating, or your knees might get weak. But at the same time, don't even think about the camera. Just think about what you're doing it for, right? And you're doing it for growth. You're doing it for a second stream of income. You're doing it for to get over that fear as well. So yeah,
I love that you said that somebody always needs your service.
Yeah, for sure.
Someone always needs your service. I was going to something last Friday, and I was like, oh, I need a cake lady. Now I'm disconnected from a lot these days. So I ended up going to Publix and getting the beautiful cakes. I like pretty things. So I'm never going to just get a regular cake. I'm going to get, it got to be pretty and beautiful. Yeah. But I was like, dang, I need a cake lady.
Yeah.
Right? Because I don't bake cakes.
Yeah.
But at that time, I was like, if I had a cake lady on speed dial, I would call her and say, hey, I need 2 cakes. I'm pulling up at this thing. This is what I need. This is what I need. So someone always needs your service. And while we're on this topic of income and on the topic of income, as we talk about qualifying for a mortgage, I want to go over your housing ratios. I know that we talked about this on the first Mortgage Minded Mondays.
Yeah.
And I want to talk about the standard housing ratios. And when I say standard, I'm talking about housing ratios for a qualified mortgage. So as you get ready to purchase your property or refinance your loan or whatever the case may be, or obtain a mortgage, you may hear the term qualified or QM mortgage versus a mortgage that's non-qualified. A qualified mortgage is a fancy way for saying that the government will back the lender, the investor, in case you don't pay your mortgage and you go into foreclosure, they'll go ahead and bail them out. And so because the government is getting involved and saying, we'll bail you out, lender, if your borrowers don't pay their mortgages and they go on foreclosures, there are certain mortgages that will bail you out, but it has to be qualified according to our standards. So because it's according to the government standards, they have stricter requirements. I hope that what I'm saying is not going over your head. If it is going over your head, I want you to run the tape back. This is important because as you get ready to buy a house, as you get ready to refinance your loan, I want you to understand that you can qualify for a qualified mortgage, which is the strictest requirements, or you can get a non-qualified mortgage. So when I give you the numbers of ratios 28-36, I don't want you to hear this and say, oh my gosh, there's no hope for me. That's not the case. You just won't be able to obtain a qualified mortgage. This is the same thing with credit scores. Now, a qualified mortgage has stricter requirements because oftentimes the terms are more favorable and they're vanilla.
Yes.
So you have to be kind of vanilla, fit in this box, in this category to get it. And that is because it's not you who's being qualified. It's the lender who's saying, okay, the government is saying this mortgage qualifies for bailout if they go into foreclosure. But that's that sweet spot. And I want to talk about that next week is the non-qualified mortgages, because I really want to talk about the loans that we do for investors that use the property, the income property to qualify. That's not a vanilla mortgage. That's vanilla with some sprinkles. When I say qualified mortgage, Mr. Henderson, I'm hearing him in my head right now. You talk about, and Mr. Henderson loves ice cream too. So he loves ice cream and I'm hearing his voice. There are some people who go into the ice cream shop and all they want is vanilla ice cream. That's it. They have the toppings laid out. Nowadays, these ice cream shops, you can add them and mix them in and they using this and that. They don't want that. I just want to go in and get 2 scoops of vanilla and on a cone, just like old school. That's a qualified mortgage. And then there are some people who say, oh, you know what? Can you put some sprinkles in there? Or you know what? You got Butterfinger and brownie? You can put that in there. You can mix in the Butterfinger and then you got a microwave. You can warm the brownie up, put the brownie in a cup, put the 2 scoops of vanilla. Matter of fact, 1 scoop of vanilla, a scoop of chocolate, and with the mix-ins and put it on Angela's, some caramel sauce and some peanuts on the top. Can you tell your girl is a fatty? Right? You can do all that. That will be a non-qualified mortgage, meaning okay, we can do some this and that. We can use bank statements to qualify. We can take a lower credit score. We can use the investment property that you're buying and don't own yet. We can use those rents as income to get you to qualify for this mortgage. We can add some of this and that and sprinkles and toss and dust that thing. And then by the time you get to the register, now the person with the vanilla 2 scoops plain on a cone, I don't know how much ice cream costs these days, but ice cream might be like $7. By the time you get to the register to check out, because you got the brownie, they warm the thing up in the microwave, put it in the cup, added the scoop, this scoop, that scoop, mix it. It's not going to be $7.
Right.
It's not going to be $7, meaning your interest rate can be higher. Meaning you may have to jump through more hoops. You may have to show all your bank statements. You may have to do a little different things. But at the end of the day, you're walking out with ice cream just like the other person. You're walking out with a mortgage just like the other person. And that's important. Can we talk about investment properties?
Yeah,
that's it. Yeah, I think that's a good topic.
For sure. Because that's what we specialize in. And we add a lot of those to the financial plans that we built for our clients. So next week.
Yeah, next week. We'll talk about it. We'll talk about different mortgages and stuff. And that's important because as I go over these numbers today, the front end ratio and the back end ratio, I'm just giving you a basic based on the QM, the vanilla ice cream standard. Now, if you say, Hyacinth, I hear you saying I need a 28 and a 36, but I want some sprinkles on that thing. I'm going to say, all right, let me see what we can do. We can raise these numbers, these ratios a little higher, but this is what's going to be required of you. If you missed the ice cream analogy, go back. So let's talk about how we come up with the HER. This is called the housing expense ratio. We call it the HER in the industry. Another term is your front end ratio. Your front end ratio takes your gross monthly income. What is gross income, Tavares? Because you know sometimes people get mixed up on that.
Yeah, so your gross income is going to be all money before it even touch your hands most of the time. So before your deductions, before your 401k, before your dental insurance, before your health insurance, before your child support, your gross income, the top line, not the bottom, right? Top line. That's the big number. So your gross annual income, let's say if you make $100,000, that's your gross. You make 100,000. You ain't gonna touch 100,000, but that's your gross. So the top line on your pay stub before any deductions, that's your gross.
Right. So it takes your gross monthly income, and I find it very interesting that the ratio takes the gross income, knowing that that's not what people net.
Child support is based off that too. Child support, alimony is based off of those numbers too. Why? I don't know. And it's crazy because people have so many deductions, and it's like your life isn't even touching the gross. You live off of the net. So you got all these deductions coming out. So it's like, why would that be it's kind of like they're setting you up almost.
You took the words out of my head.
Setting you up. Yeah. And it's like it's so confusing because it's like I'm not even touching that money, but you're able to use that money. But that's another reason why the credit score is so important, right? You see how everything falls on credit score. They want to see how responsible you are, right? So if they're going off your net income or your gross income, I'm sorry, and then if you were able to purchase a home with a 500 credit score, then that's like, that's really setting you up for failure. They're like, you ain't really responsible, and we're gonna take your higher top line number.
Yeah, I said the same thing. I said, gosh, it sounds like a setup.
Yeah, man. Yeah.
And now on the flip side, they only take a small amount. Yeah. So your gross monthly income, your housing expense ratio, divided by your housing expenses. This means if you're qualifying for a mortgage, this means what the mortgage payment is going to be. So your gross monthly income divided by your housing expenses can be no more than 28% of your gross monthly income. Yeah. These are a lot of numbers. So I wrote down some gross monthly incomes, and they're the numbers that mortgage payments that you will be able to qualify for. So if you have a gross monthly income before taxes, not what you see after taxes, if you have a gross monthly income of $3,000 a month, your housing expense ratio, your HER, on a plain vanilla mortgage, no sprinkles, no sauce, can only be $840. That's the most your mortgage payment can be.
So that's why the pre-approval that's where the pre-approval comes in at. Because sometimes people go home shopping before they actually get pre-approved by a lender.
Let's talk about
and you will go out and you will look at all these beautiful homes, and you in Miami Lakes and you're at West Miramar, you're at Pembroke Pines and things of that nature. Like, oh my God, it's so beautiful. They got the palm trees, 2-story house, or they got the crown mold, and they got a pool in the back, and it's a lake back there behind the pool. And and then you start having family events at your house in your backyard, right? And then you start furnishing it, right? But then you're like, man, okay, so let's go to the drawing board. Let's get pre-approved. Let's go ahead and submit a contract. But then that's when you submit your financials, your mortgage broker, you send it in to me and Heisey, and we see your gross income, right? We get a pay stub, and we see that your monthly income is $3,000. So we're like, okay, with $3,000, you qualify for $840 on a monthly basis. So now we have to reduce the amount that you qualify for, meaning the total purchase price. So in your mind, you just looked at a $800,000-$900,000 house, but then you only qualify for a $300,000 or $400,000 house. So now you just glimpsed at $800,000 homes. Now you got to go down half, right? Your budget has been reduced by half. So now when you're looking at these homes that are in your budget, now you're like, I don't even want to buy a house. So look at this, and the camera's not right, or the sink is outdated, so now those things are starting to pop out at you like a sore thumb, which is why your income is really important, which was the topic we spoke about prior to this, right? Adding some more skills to what you do, so you can increase your income. You increase your income, you can increase the home size that you purchase.
Yeah, I
It's
love that
domino
you.
effect.
Yeah, I love that you tied that in. That's why it's so important that you actually tune into these shows. That's why we started doing these shows. You gave a beautiful example when you said you actually go, you look for the property, you start envisioning yourself. Oh my gosh! And we all know once you get a vision in your mind,
Oh man,
like I already know where the couch gonna be, my
yeah,
room gonna be over here. I'm gonna have a barbecue, and this. You start envisioning that, and then you come back and you find out that you can only qualify for $840.
yeah,
It's going to be hard for you to say, oh, I really do have champagne taste in a beer bottle budget, right? So I want these extravagant things, but based on my gross monthly income. And let's take it up. Even if you make $7,500 a month gross, 28% of that is $2,100. $2,100. That's 28%. And this is with the plain vanilla mortgage. Remember, vanilla means a qualified mortgage.
Yeah.
There are non-qualified mortgages, which is going to give you, they can give you the brownie heated up in the microwave, baby. They can give you the sprinkles. They even got nuts that you can put on the top and caramel sauce and a little drizzle. They got all that for you. You're going to pay for it.
Yeah.
You're going to pay for it, but they're going to say instead of it being 28%, maybe we'll take a 35%. They'll let you go up a little bit more than the 28%. But this is important for you to know right now today, so that as you start thinking, I am going to buy a property, I'm not getting discouraged. That's, again, we're not here to discourage you. We're here to inform you so that you can get prepared. I'm gonna buy a property. What I need to do?
Right. And I'm glad Heisty mentioned that, because as she just mentioned, that they're willing to go up, or they're willing to add some nuts or sprinkles to your ice cream cone, but you also have to be willing to go up. So if that $2,100 per month doesn't buy you the house that you're looking to have, then you have to go up in your credit score, right? You have to go up in your cash to closing. You have to go up in your reserves. You have to go up in, what you're able to afford. So you have to bring, it's like you're dating almost, right? And you're dating the house that you're looking to purchase, and your spouse may not be a cook. Right, dudes, we want to check the, go in the kitchen and be able to, fix up something, make some collard greens like mama used to, or make some salmon, like, bake me some chicken or something like that, right? But she may not be a cook. She may be fine as wine. She may have hips popping off. She may have a pretty white smile, right? But she just may not be. She may be a dud in the kitchen, right? Make a long story short. So you may have to step it up in that department. Right. So in the areas that she lacks, you step it up, and vice versa. Where you lack, she steps it up. So if you want the lender to look past your DTI, let's say your debt to income ratio is a bit high, then you'll have to step it up in some other areas, right? You have to bring a stronger credit score. You may have to bring more cash to closing, because the thing is, they're taking more of a risk on you by having that high debt to income ratio. So if they're willing to take on some risk, you got to be able to give some, saying, hey, thank you for looking past that, right? I know in that department I'm not strong, but hey, what if you shift your attention over here? How about my credit score? I got a 750 credit score. That should be able to help me out. But it's give and take, right? As Mr. Henderson always say, you can't get something for nothing. Sometimes people, you can't want them to overlook your high DTI and your low credit score. You got a credit score, you just passing by the skin of your teeth, right? You got a 620 credit score, you just getting by, and your DTI is high, and you ain't even really got savings like that.
Put money down.
You ain't got savings like that. You know, well, they need to do this, they need to do that. No, you need to do. You need to do.
I love that. Beautiful, beautiful example. You got to give something to get something. Yeah. Betty Wright, right? You know about that song? Yeah. Betty Wright. So I love that example, because oftentimes what people do is they'll get discouraged. I didn't qualify. I couldn't get it. Go back to the drawing board.
For sure.
So let's say you didn't watch our shows, you're not tuned in and tapped into Mortgage Minded Mondays, and you're not preparing your strategy and making the moves, and you go and you jump out there. You jump out there and you think you're about to drown, and instead of, I love this. Instead of you jumping out there, you jumped out there with no life jacket, no swimming skills, and instead of them letting you drown by giving you the mortgage, and you ended up in foreclosure in a year. They said, no, we're gonna pull you back out of the water. We're gonna throw you on the shore, but we're gonna keep it moving. Instead of you sitting on the shore and saying, they just threw me here, they ain't come and change my clothes, they didn't ask me if I was okay. In other words, instead of them saying, you don't qualify for this mortgage, we're going to put you over here. Instead of you saying, I can never get a mortgage, I don't qualify for a mortgage, it's hard, mortgage is only made for this type of person, you got to be this. while you sitting on the sand sopping wet, that's your opportunity to just look and say, okay, what do I need to do? Because they could have let me drown.
Yeah.
They could have gave me something that would have hit harder on my credit for 7 years, such as a foreclosure, as opposed to them pulling me out now, my ego getting bruised because I didn't qualify.
Yeah.
And I know I had visions of the Christmas tree being in front of this window and how I was going to put the gas grill over here. I know I had those visions, but that's a smaller hit. That's just me gulping a little water, going under the water, as opposed to me fully drowning. So now that you're over here in the sand, stopping wet, it's time for you to say, okay, let me take off these clothes. Let me take a bath. Let me get some new clothes, i.e., let me look at my credit. Let me build a strategy. Let me start saving my money. Let me increase my income. There is so much money for you to be made because people pay for what they don't know. People pay for what they don't know. If as long as there are things that people don't know, they're going to have to pay somebody to either tell them and or do it for them. That's what people pay for. Yeah. So whenever you think that there's no more money to be made, always remind yourself, people pay for what they don't know. Think about yourself. If I have to take my car somewhere, if I have to pay because I don't know how to do it and or I don't want to do it. When I pay to the people to come and clean my house, do I know how to clean? Yes. Do I want to do it? No. So when you think about that, you can get out of the rut of thinking, oh, this is just, it's no more money. I can't make no more money. Go learn something. Go increase your skill set, go make some more money, and then you get back on that boat and say, now I'm ready to jump in. And when you jump in, you're going to be able to qualify for a mortgage. So we talked about your housing expense ratio, which is your front ratio. Tavares, you mentioned the DTI, which I love because it segues right into the back end ratio, which is your debt to income ratio. Your debt to income ratio, another acronym that we use for that is the TOR, T-O-R, total obligation ratio. Now the front, we just talked about your housing expense. This means if you want a house for $750,000, you're going to need to take your gross monthly income. And if you want to qualify a mortgage with the, I don't want to say best because regulations, but just straight up terms, it can't be any more than 28%. Now, when we get to your back end ratio, that's higher. It's 36%. So your back end ratio, what's that composed of, T?
That's everything. Like Heisey just said, total obligation, everything that you got to pay, your credit cards, your car note, your student loan, everything, every debt that's tied to you. They're going to total that number up, and it has to be, it was 36%, you said? So it has to be 36% of your income, no more than 36% of your income. So 36% or less. And that's where we try to have things to reduce your debts, right? So we have YFB. I want to mix information, but we have YFB, right? Your Family Bank, where we educate our clients on how to pay off their debts, right? So that can be used. And then YFB, some people say, I had a few calls last week of clients that have Your Family Bank, and they were paying off a few debts using their Your Family Bank system, right? And you borrow from your life insurance policy or borrow against your life insurance policy to pay off debts. So you're shifting debt from your creditors over to the life insurance company, and then you repay the life insurance company. It's a beautiful thing because it removes the debt that lenders can find. So when you owe a life insurance company, nobody can find that. It doesn't come up in your debt. If we do a credit pool, if you owe Mutual Trust or Columbus Life or National Life, all of those, insurance companies, if you owe them $20,000, $30,000, $40,000, it's not going to come up on your DTI. It's not going to come up on your credit report. So it's like a way to hide things, right? Strategically, how to hide. But if you owe your credit cards, that's going to come up on your credit report. It also, the monthly payment that you're obligated to pay them, that's going to also come up in your credit report. And all of that is calculated in that 36% back end ratio. So utilizing the strategies that we've been, informing our clients about and teaching our clients about, they all go hand in hand, right? Though they've been presented to you guys in different sectors, they all go hand in hand. And that's one thing that you kind of got to give us a pat on the back for that. You got to.
Yeah. I love that you brought the YFB into the conversation and cash value life insurance, because on your loan application, guess what? They're going to ask you, do you have some cash value life insurance?
Yes.
Not because they want to know if you have loans, but because that's seen as an asset. Yeah. Do you have cash value life insurance? It's seen as an asset. And I love that we talked about, I just lost my train of thought. I think that was Antonio. Somebody I heard. I love that you talked about, removing the debt from your credit report.
Yes.
using
your cash value
your
life
cash
insurance.
value life insurance policy to borrow against the cash value life insurance policy, take out a loan. We're going to say that word, borrow against it, take out a loan, and then get rid of the debt that is showing up on your credit report.
Yep.
How beautiful is that?
Yep. Beautiful thing. And then when you take that, when you borrow the money from the life insurance company, it doesn't come up on your credit report.
No.
Strategy.
It's
So
strategy.
So it's awesome to stack as much money as possible inside of life insurance. And you're thinking about paying off, you're thinking about purchasing a home, rental property, secondary home, primary residence. Go ahead and pull some of those funds out and pay off those debts. Now you just eliminated those creditors. Now you're looking really good. You increase your credit score and reduce your DTI, your debt to income ratio, so you can qualify for more home. Because if your debt to income ratio is, the higher it is, the smaller house that you can purchase, the smaller your home price you can purchase.
Yeah. So let's give them some numbers too. So we talked about the HER and what those numbers look like. So if your monthly gross income is $3,000 a month, your back-end ratio for a QM, a qualified mortgage with plain vanilla, no sprinkles, 1 scoop, not even 2. We're going to take it down. 1 scoop, plain vanilla in a comb, like back in the days.
Wow.
36%. Your DTI, your total obligation ratio, TOR, can only be $1,080. That means your mortgage plus your car note plus your credit cards. What else shows up on credit? Plus other loans, plus student loans can only be $1,080.
What was the income on that?
$3,000 a month.
Wow.
But look, if your gross income is $7,500 a month, your total obligation ratio can be no higher. If it's 36%, that amount of house you can buy, $2,700 a month.
Wow. And not many people, I say wow because not many people are making $7,500 per month.
Come on now.
Not many people. And on top of that, they say 80% of cars on the road have a car note tied to them.
Yep.
So that's going into the debt income ratio. So not many people are making $75 per month. So most people are making less than that. But most people have obligations like a car note. So that's also dipping into what you can put towards a housing expense. And now it seems like average car note what I'm seeing is about $800 some odd dollars. About $800 some odd dollars. So 800 out of that 2,000, what was that?
$2,700.
So 800 from that, you got about $1,900 left. That's just going to house. That means no student loans, no credit cards. No student. We all got credit cards. The credit card debt just went up to $1 trillion. So we all got credit cards. Wow. So that just puts some things in perspectives on how you want to build your profile before you come present it to Hyson and myself. Hey, I'm ready to purchase a home. Show me the documents that you're ready to purchase a home. Don't just talk about it. Show me the documents that show you ready to buy, right? Show me, now you know what the DTI is, right? So you guys can speak to us as we speak to each other. Hey, my DTI is this. Or hey, my front end is this. Or hey, my gross income is this, and I did the calculations already, so I should qualify for about this much. Because we giving you guys the game, so you guys can pull out a calculator and pull out your pay stub and do some calculations and say, man, okay. And then you can also pull out your monthly budget, which we all should have. How much I'm paying on these credit cards? How much I'm paying on these student loans? Right? And October is right around the corner, so we have to add that back to the DTI, right? So if you purchased a home in between 2020 and I would say this month, September, you could have excluded your student loans from your DTI because it wasn't a required payment, and it's been off your required payments for so long, maybe about 3 years. So that's like 36 months. But now starting in October, you have to re-add that student loans to your DTI. And I don't know why they came up with that. That was kind of crazy. So another setup, but
yeah, another setup. I agree. And we're getting the calls on it already. Like my student loans, I got a call last week. My student loans are about to come due. I got to think about my budget.
Yeah.
How am I going to pay for this? What am I going to do? Because I haven't made a student loan payment in almost 3 years. What am I going to do now? So you have to think about these things. And so as you're listening to this, then you can make better decisions. Yesterday, again, I'm at the mall taking my son so we can get ready for Granny's memorial service. And I get to the register at a store. I can't remember which store I was at. And the lady, I guess my whole aura was like, I ain't going for that. But she repeated, did you know you can save 20% by applying for a car and this, and this? And I said, no, thank you. She said, I know, I just had to say it. And I was thinking to myself, I just talked about this on my show last week.
Yep.
I just talked about this. No, thank you. So as you're hearing us educate you on this, it's not because we just want to talk. It's because we want you to start looking at your credit, your income, and making new decisions. Now you should be thinking, how can I get stuff off of my credit report? Not only the negative things, but how can I reduce my monthly obligations? I told y'all last week, I try to keep mine as low. Listen, no car note, no credit card debt. I be like, listen, don't give me nothing that I have a monthly bill to pay every month.
Yeah.
I've got
Yeah.
we gonna travel and we gonna go eat.
Right.
But I'm not gonna add to a monthly expense. And now you see why. Because I want, when you put my credit report, baby, it's clean. And you should want that for yourself as well, and start making those decisions, because they will entice you to get a new car. Yes, I want a new car. I don't want to pay the car payment.
Mm-hmm. That's what mindset comes in at.
Mm-hmm.
And mindset has so much to do with our decision making, right? Mindset has so much to do with our decision making.
Mm-hmm.
And I almost said something, but I'm a
say it. Don't you want me to be the only one that be saying it?
Nah.
Okay.
Maybe for another one. I'll say that for another show.
All right. If you scared, say you scared.
I'll say that for another show.
If you scared,
but yeah, so your mindset has a lot to do with your decisions. And your decisions have a lot to do with your lifestyle, right? So you're gonna have friends that buy nice stuff and wear nice stuff. We spoke about this on last week's show. I don't want to be redundant, but you have to have the cojones to say, you know what, I'm gonna do what I want to do. I'm not gonna be led by an influencer online. I'm not gonna be led by somebody that's in my break room that just got a new pair of red bottoms. I'm not gonna be led by any outside forces. I want a new house. I want to rent a property. I want to increase my net worth by purchasing real estate, right? And it's on you to do it. You have the power to do exactly what you want to do. When you turn on that willpower and turn on these shows and you add the two, or you combine the two, the information from the shows and also your willpower, you can take your life to the next level.
Absolutely. I want to go back before we talk about grossing up income. I want to go back quickly to you talking about taking a loan from your cash value life insurance policy.
Mm-hmm.
It's a beautiful thing, because here's the thing. People often ask me, do I have to pay this loan back? Mm-hmm. And I'm going to tell y'all what I tell them. I say, you don't have to do anything.
Mm-hmm.
You don't have to pay your loan back. Mm-hmm. They aren't going to beat you over the head. They aren't going to say you took a loan on September 4th. On October 1st, your first payment is due, and this is the payment amount. You don't have to do anything, as my mom used to say, but stay black and die, right?
Yeah.
But if you do not pay the loan back, the next time you need a loan, the money is not going to be there.
Yes.
Now, it's beautiful to think about if you're using your cash value life insurance as a part of the strategy to purchase a property, because you can say, well, I'm going to take some money from my cash value life insurance. I'm going to borrow against it, pay down this debt, pay off the debt so that I can increase my score, decrease my ratios, my liabilities, qualify for the mortgage, get into the mortgage, get into the house, get it decorated, do whatever I need to do without the added pressure of having another payment of, okay, this loan is due at this date, this time, we're going to start calling you if you don't pay it back.
Yeah.
So a lot of times when you eliminate the debts so that you can qualify for the mortgage, it really is a blessing, because now you don't have to pay that $500 monthly debt anymore. You don't have to pay that $300 monthly debt anymore. And the life insurance company isn't beating you over the head saying, pay it back. Do I advise that you pay it back? Absolutely.
Mm-hmm.
I advise that you pay it back. The way that I tell people when they ask me this, it's like you borrow clothes from your closet every day. Imagine if I borrowed this dress from my closet today, and this is one of my favorite throw on dresses. And after I wear this dress, afterwards, I never wash it and put it back in my closet. Next week or next month, when I have to just go somewhere and I want to throw on something real quick, I don't feel like ironing, the dress isn't going to be there, because I did not clean it, do what needed to be done, and put it back. So when you think about putting money back into your life insurance policy, no one's going to make you. You just won't have no clothes, right? And so in the instance of insurance, no one's going to make you, but at the time that you do transition to wherever you're going to be, your death benefit is going to be reduced. It's like, we're not going to make you, but okay, if you want to keep doing this, if you want to wear this dress in 2 weeks or another, then wash it, do what you need to do and put it up.
Yep.
If you want to borrow from your policy, then, get your footing and then start making payments back.
Yep.
So you have to think about it in that way.
Yeah. And just to add one more point to that, just thinking from an underwriting perspective, if you pull funds from your life insurance policy or you borrow against your life insurance policy, you also have to pull to pay off debts. You also reducing the amount of money or avoiding pulling money from your down payment that you saved in the bank, right? Because if you have to pull from your down payment that you saved in the bank to pay off some debts, then now you're reducing your chances of getting in the home, and you're also going to spark questions from an underwriter perspective. So pulling those funds from or borrowing against your life insurance policy has more benefits than one when utilizing it that way.
Yeah. And we want you to do this ahead of time.
Yeah.
Like, you don't even have to wait until you're ready to, hey, Tavares and Hyacinth, go ahead and pre-qualify me. I'm ready to buy a mortgage. You listen to this show now, you know you got some debt you were supposed to pay off and you didn't pay it off.
Yeah.
That's why one of the things that I tell, especially my young people that come here for financial planning, let's talk about a cash value life insurance policy. You're going to need it.
Mm-hmm.
You're going to need it. You put money away, you're going to need this. Let's talk about this. And that's one of the first things that I get people that I suggest to people, or that we talk about before we even talk about the investments of the stock market. Because as much as I love the stock market, as much as I love investments, understand that that thing's going to go up and down.
Mm-hmm.
And if you don't have something old, faithful, and old, reliable on the side, when that thing gonna go down, you're gonna be looking like, what I'm gonna do?
Mm-hmm.
And I'm be looking at you like, what you gonna do?
Right.
Because I told you to put that safety nest egg down there.
Mm-hmm.
Right. Okay. Let's talk about non-taxable income when it comes to qualifying for a mortgage. So we talked about your ratios on a qualified mortgage, non-qualified mortgage, vanilla. Non-qualified is sprinkles and 2 scoops and a brownie on the bottom. If you missed that, go back and watch it. I also want to let you all know, for those of you who receive things like alimony, child support, Social Security income, disability income, certain VA benefits, certain pension benefits, income that is non-taxable. Non-taxable income can be what we call grossed up by 25%. Mm-hmm. So that means, and there are some other requirements that come along with this, such as you have to continue receiving the income for a stated period of time. Mm-hmm. I'm just giving you the basics. When you come to qualify for a mortgage, we'll talk to you about that. Mm-hmm. So for instance, if you receive child support and your child is 17 and going to be 18 in 6 months, well, we're not using your child support income. That's just not going to work that way. Mm-hmm. But for the sake of this conversation, if you, let's say you receive $1,000 a month in alimony or child support, you can gross that income up by 25%. So instead of the underwriter just counting the $1,000 a month you receive, they're going to say you receive $1,250. That's helpful information. Very helpful information, because we just talked about you needing more income so that you can help your ratios. And you may be listening to this and thinking, oh my gosh, I don't have enough. The child support can be grossed up. Your Social Security income can be grossed up. Disability, VA income, alimony can be grossed up. All those things can be grossed up 25%. And when I think about Social Security income, and then I think about child support income or alimony income, what I see is a family who have been living together, and it's a multi-generational family where you may have the grandmother in the house or the mom in the house who's eligible for Social Security or maybe gets disability. And then you have a younger person in there who's getting alimony or child support, and she also works, and she wants to buy a house. But since you live with grandma anyway, why don't y'all come together on this mortgage and use the income and get very creative so that you can qualify for the mortgage?
Yes. That's
what do you think about that?
That's a beautiful thing. A beautiful thing where it's all, I know a lot of people have their idea of group economics, right? Where they say, okay, well, if you look at like a certain culture, then you shop with that culture. You spend money with that culture instead of going outside of your culture. Keep the money floating within your particular culture. However, another way of group economics can be what Heisey just described, right? We're going to live together. Instead of, me being 18 years old and I just move out of the house right away and just trying to learn through trial and error, because this thing called life is really hard. And especially life in South Florida is really expensive. So we can practice group economics together, our portion, or our way of group economics, by sticking together as a group and purchasing property as a group. So grandma, mom, and son or daughter, we all come together to get ourselves together to purchase a property. So we're all, if one of us wanted to purchase a property, we probably won't qualify. If 2 of us, we probably won't qualify. But with the 3 of us, we can definitely not only qualify, but qualify for something nice. A nice area, a nice home, something that we'll all be comfortable in. Nobody have to share any rooms. And it's all family. So it's not like we're roommates and we're posting ads on Craigslist for complete strangers to come in. We all know each other. Yeah, we might have some hiccups or some run-ins, but at the end of the day, we're all family. We're all close. We'll get past that. So we can sit together, put our funds together, not literally, but just when it comes to make the down payment, you guys can have your own separate bank accounts and make the purchase.
Yeah, and make the purchase. It's a beautiful thing.
Yeah.
You don't have to add the stress. And I love when my 20-something-year-olds, they're still living at home and they're like, they want to get out. I'm like, why? Why?
Right.
Why you want to get out?
If I can go back today, I would.
Me too.
If I can go back today
with my children,
I'm gone.
Me too.
I'm gone.
You can even give me a curfew.
Yeah.
Tell me what time to be home.
Yeah.
Give me chores.
Yeah.
Absolutely. Yeah. Me too.
Yeah.
Me too. But you have to think about this. I love that you brought in the topic group economics because it's very, very true. A lot of times you have to work with what you have to get the things that you want.
Most
Players
definitely.
Club. You got to use.
I hear you, Diamond.
You got to learn to use what you got to get what you want. You have to look at where you are. Oh God, laughter is good. I appreciate that. Thank y'all. You got to look at where you are and you look at your resources and look at instead of saying, oh man, I can't qualify. Listen, you need to help take care of your mom or your grandmother anyway. Y'all been living together anyway. Why are you rushing out? They're going to miss your family contribution. You don't know it yet. You're going to miss them helping out too. You're going to miss them definitely them Sunday cooked meals. Yeah. So why don't we have a conversation and say, okay, my income, your income, my credit. This is how we can get together so that we can buy this house and we can achieve our goal of home ownership and we can help each other out at the same time. Because I know a lot of you didn't think about that. So that's something to think about. And then also think about the grossed up income. Now, here's the thing, and we'll get into this more next week when we talk about investment property, which is a lot of the mortgages that we do and what we talk about, because we include real estate as a part of our financial planning portfolios. Rental income is grossed down. Mm-hmm. So what that means is if you are receiving $1,000 a month in rental income, the underwriter is not going to take that as $1,000 a month. They're going to take a 25% reduction. Mm-hmm. So we just talked about a 25% increase. Now there's going to be a 25% reduction. Mm-hmm. This isn't good or bad. Mm-hmm. As we talked about on the credit show last week, nothing is good or bad. It just is.
That's the rule, yeah.
Once you have the information and understanding as to why, then you can create your strategy. Mm-hmm. And that's what we want you to do, is to understand, to get information, to understand, and then create a strategy for success. Mm-hmm. So there's several steps. Get the information, come to understanding, create the strategy, achieve success. Most people do not take the time to get the information and gain understanding. They just try to jump over here. And when they're unsuccessful, they say that they can't. It doesn't work. It was too big. The dream was too lofty. And that's not the case. You just skip steps. So let's go over those steps again. Get the information. That's what we're giving you today. Gaining understanding of how these things work and why they work that way. Very important. Develop a strategy. Developing a strategy means you can't just watch us and be like, oh yeah, that was good, and then turn us off and go back to watching Real Housewives of XYZ. You can't turn us off and then go back to maxing out your credit cards and saying next week and this and this. We love that you watch us and you share, but we really want you to help yourself. So the strategy means you got the information, you gain information, and now I'm going to take this information and couple the information with action. That's how you get to wisdom, and implement this strategy. When I implement this strategy, success is the next step. That's it. Mm-hmm. Success is the next step. So within anything in life, if you find that you keep missing the mark and you're not successful at your goals, wishes, dreams, hopes, aspirations, desires, if you keep missing that mark of success, well, let's reverse engineer this. What was your strategy? I don't have a strategy. Oh, this was your strategy? Why was this your strategy? I don't know. I just said this was a strategy. Why did you? Okay, wait. Did you understand this? No, I didn't understand. So now you got to go back and get understanding. Well, how can I understand something I don't know about? Oh, you got to get some information. Mm-hmm. Now you see why education is important. Mm-hmm. Now you see why at the Henderson Financial Group we consistently educate, mm-hmm. because we know it's education, mm-hmm. information, understanding, strategy, success. You cannot look at us and just be successful. Don't work that way.
Yeah. And now that you guys have the education that your rental income is going to be deducted by 25%, mm-hmm. that could be a good reminder for some of you guys to start raising your rents, right? Because a lot of time, I'm not saying with egregious amounts, right? Like, I'm not asking you to price gouge, but a lot of times we'll get a tenant in the property and we won't raise it for 10, 15 years, right? And we end up, man, they're in this situation or that, right? I mean, you could raise about $100 a year, right? $150 a year, or $100 every 2 years, right? But you just want to make sure that you're gradually increasing, right? Because eventually, you're going to want to purchase property soon. And guess what? All that full amount, that gross amount that you're receiving, you're not going to be able to add that full amount to your loan profile. Only 25%. Oh, well, 25. It'll be deducted by 25%, right? So yeah, that's just a good reminder for you to just with grace, right? Not you don't want to pull out your Vaseline when it's time for a new lease to come out. No, just keep in mind that it's a human being on the other end.
Yeah, people were doing that. Great point. When things shifted down here in South Florida and a lot of people started coming here, they were just raising the rents by $1,000 a month, $600 a month. I remember, Tavares, I'd be heartbroken sometimes.
Yeah, that's crazy.
I'm like, how could you do this?
That's crazy.
These people are teachers. How could they? It's just the way of the world,
that's
right?
Crazy.
But we're not suggesting that you do that, but we are suggesting that you do increase your rent, because you're right. Sometimes people, they've been there for 20 years. I never raised the rent once. Raise it $100. That'd be okay.
Homeowners insurance going up like crazy. Property taxes going up like crazy. So you want to make sure that it makes sense for you. I know you may be getting a depreciation and a tax deduction on an annual basis, and you capitalizing them, but you just want to make it make sense on a monthly. At least let the property pay for itself. At least.
Yeah. And so here's the understanding of why they give you a 25% haircut on rental income, because they understand that things happen. They understand that things go up. They say, well, we know that in this world that we live in, the likelihood of you getting 100% of your rent on time, every time, all the time, and nothing ever happening. No tenant not needing a new hot water heater. No tenant not flushing a rubber ducky down the toilet. The chances of that happening are slim to none. So as we know that you're collecting $1,000 a month, we're going to set aside, we're going to take a haircut of $250 a month, because things come up. And you're going to have to, so you don't be a slumlord, you're going to have to put stuff into the property. You're going to have to do certain things into the property. Things are going to go up. So we're going to give you that haircut because we understand that. I think we've given them a lot of information today.
Oh yeah. I'm not sure.
I need to call my tenant. That's why I'm like, okay, let's wrap this up. Let's call my tenant. But go ahead. Don't speak. Go ahead.
Yeah. So this was a good one. I'm not sure if I like this one better or last week's. I think they both were pretty valuable, but actually we'll let y'all decide. How about y'all check them out both? You may have somebody that's looking to purchase a home. Let's say you're probably going to purchase a home with your girlfriend, right? But now you may want to have a conversation with your mom and your grandma, right? Because purchasing your grandma or your girlfriend not forever, right? Your grandma and your mama, they forever. Those women will be in your life forever. But girlfriend, she could be here today, going tomorrow, leave with that mortgage that you can't afford. Now you got a foreclosure on your back, and that's a whole nother whirlwind that you don't want.
You said that, because I don't. Now we talked about banding together and purchasing property.
Yeah.
Now I used to always tell my women, don't you purchase this. Yeah. I don't advise. I don't suggest that you purchase a property with someone that you're not legally married to.
For sure.
And if you do go against that, because you can do whatever you want to do in this free world, I do suggest and advise that you look at the numbers and be able to afford the property even without the other person's income, because things may happen. Things could happen. And let's even take a step back. Let's say, y'all relationship is the best since sliced bread, and then the unfortunate happens and something happens and he goes on to the next lifetime. Right. So he didn't leave, but he transitioned. How you going to pay this mortgage? So I will always tell my women, make sure you can afford this mortgage without that other income.
Guys, y'all too. Right. Ladies, y'all not in it alone. Guys, y'all too.
Yeah. I mean, just think smart. Smart. But I wouldn't advise anybody to purchase with your girlfriend or boyfriend. Unless you're of the people that are saying we're never going to get legally married, but we're going to be together. We're against legal marriages. Remember, I was against them at one time. Right.
Yeah. How could I forget? How could I forget?
How could you forget? Right. I still don't know if I want to actually sign the paperwork, but that's the topic for another day. But I was against getting married. Remember, I was like, no, one and done, I'm good. But now I'm open. I actually want to get married again.
That's what's up.
But back to the topic. think about that, because this is, like I say, this is not buying a t-shirt. This is not something you can return. This is a whole mortgage. So you have to think about that when it comes time for you to qualify for things. Tavares started talking about buying property with your girlfriend and boyfriend.
What about, because it's a whole group of women out here, right? That say they don't need no man. And they're like, we all single. So you know what, girl, we might well buy a house. They're all homegirls and they buy a house together. What about friends purchasing property together?
Would I do that, or would I suggest that?
What's your thoughts on that?
So
I have mine on it.
Yeah, it's not for me.
Yeah.
It's not for me. I that's something else that I no, we're not purchasing as friends. I got maybe a business partnership, but even I don't know. No, the answer right now is no. It's a no for me. However, I don't know what your situation is like.
Right.
I do encourage you to get your legal document and paperwork in order, and I do encourage you to look at your friends and look at character, man. That's very important.
Yeah.
Would you do that? What do you think about that?
My uncle Mike, right? He did 33 years in the federal prison, federal prison system, right? And he came home. When guys go to prison, they come home, they have all these, sayings and stuff like that. And the word friend came up in conversation. It was like, nah, I don't do friends, right? He did the little face, nah, I don't do friends. Like, why? Look at the word friends. He said Friend. If you break it down, that's two words. Fry end. It's gonna get hot in the end. That's what he said.
Oh, I love it.
Fry end. It's gonna get hot in the end. So I don't do friends. So that's just always stuck. At first, in the moment, it was funny as ever. It was Thanksgiving. It was his first Thanksgiving out of prison. It was my first time meeting him, right? Because I'm 33 years old, and he did 33 years in the prison system. So, and that's how I remember him. That's how I remember him. Fry end, friend. It's gonna get hot in the end. So no, it's not for me.
Yeah, I agree. I think, understanding now, I'm at the point, and I never did that before. I never had a desire to do that before, or a need to do it, right? But understanding now, one of the things I'm always learning and reading, and as I keep studying about people and things like that, you just start to understand people and their interests and why they're connected to you.
Yeah.
And I was 41 years old. How old am I now? 42? I'm 42.
48.
You're such a hater. If I'm 48, you 40 tomorrow. So 42, right?
Yeah, 42.
Probably at 42. Let's see, I've been 42 for a month. So probably late 41. I just now realized that people come to you with ulterior motives. I know it seems simple. I know a lot of y'all knew that. I didn't know that. I didn't know that. It wasn't until my late 41 that I was like, oh, when someone comes to you, they can be disguised as a friend, a lover, a business partner, whatever the case may be. They already have their motive, their interest in mind. What you want to say?
I'm listening.
Ahead of time. That's been so mind-blowing for me. And I'm not against meeting new people in relationships, but now I feel better equipped. And this is talking about friends and acquaintances and things like that, because I'm like, this person already has a motive in mind. So when you talk about buying a property and signing a mortgage with somebody, that's why I keep saying, get your paperwork in order. And when I say get your paperwork in order, I'm not only talking about the legal documents that outline who's the owner and who's not. I'm talking about them greenbacks paper, because the only way that you can enforce legal documents is with some paper, is with some money, right? So when you have to have the lawyers get involved, then guess what? You got to pay them. Before you can even get the lawyers involved, you got to pay retainer fees. You have to pay hourly fees. By the time somebody makes me lawyer up, you can't never talk to me again, because I've spent all this money paying this attorney to get this done, and we could have got it done, but since you made me spend the money, you can't even talk to me no more. Go ahead, T. I'm sorry. I'm not sorry, but
Yeah, so we appreciate you guys stepping through.
I thought you was gonna say something. Don't hold your thought in. You were smiling and stuff like you wanted to say something.
I was listening to you. And you got to call your tenant too, right? So
y'all seeing this on real time.
We appreciate y'all stopping through on this beautiful Labor Day. Don't eat too much, but share this, like it, and rewatch it, right? If we said something valuable, drop a comment. We appreciate people that did come through in the comments, like Miss Redhead, Kaylay, Mario, and Grayo. Those are our regulars. Kaylee is the first one. I never saw that one before.
Hell Wildcats. Who is that? Is that
And that's Bethune Cookman. I don't know.
is it college football today?
I think that no, it's college football is Saturdays. But
Hmm.
shout out to Kaylee, and we
Mhm.
appreciate that. Go Wildcats. Go Wildcats. Yeah. So that's it.
That's it. I
That's
think
it.
Mr. Henderson and I we were on last Wednesday. I think we'll be on this Wednesday. We may be on this Wednesday. He's not going to be on Saturday for certain. My granny's service is this Saturday, so we won't be on this Saturday. His T-shirt, I am.
Oh,
Oh, that's San Francisco. Is that San Francisco?
yeah.
Oh, that's Kaepernick, right? That's how you pronounce his last name?
Yeah.
Oh, but the colors. Okay. And I'm
Yeah.
usually on with your dad. Okay, well, thank you for coming on with us today. We appreciate
For
that.
sure. For
We
sure.
appreciate that. He won't be on this Saturday, but we may be on this Wednesday. And you can always run the tapes back. You can always come back and watch the previous shows. We appreciate your support more than you supporting us. We appreciate you supporting yourself by actually implementing what you learn here, implementing the strategies. You have the formula, and we want you to be successful.
That was a
So-
good one. That was a good way to word that
It
on the
was.
exit. Yeah.
We're gonna have to write that down. I'm gonna have to go
That
back and
was a
write
good
that so
one.
I can say it again.
Yeah.
All right, there's another laugh. I love it. All right, y'all. Until then, stay safe and stay sane. Peace.
Peace.